Hello everyone, today's video is all about Credit Suisse and the recent collapse of that bank and of course the merger that was instigated by the Swiss authorities between Credit Suisse and UBS, but just particularly homing in on one aspect of what was on the balance sheet. But Credit Suisse, interestingly enough, not like many bank collapses whereby there was issues with liquidity per se or not enough reserves. It was basically just a loss of confidence in the bank, and the bank had been in all sorts of hitting all sorts of bad headlines for many years, and there was just a general consensus that things had gone from bad to worse in terms of how it was managed, and one thing led to another. But anyway, this video focuses on the so-called AT1 bondholders, because what's really interesting about this is that this has set something that's quite unprecedented in the world of corporate finance, and indeed the pecking order of what happens to relevant stakeholders when a business goes under. So what am I talking about? Well, okay, basically the rule of thumb is if you have equity in a business, in a company, you're a shareholder, you will be the last to get paid in the event that things go belly up. That's the real generalism. The shareholders are the last to get paid. They're at stake to lose everything, potentially. The people above them in the pecking order would be debt holders, so people who have lent money to the business. They would get paid out first in the event of an insolvency. The debt holders, indeed above them, you get preferential creditors, like in the UK you'd get HMRC and various people. So there's a pecking order of who gets paid out in the event that business goes into trouble and it turns out there's only so much available funds to pay out. Who's going to get first dibs on it? Now, what was interesting and pretty much unprecedented in Credit Suisse was that it upended the traditional rules on that pecking order, and this is what everyone was kicking off about. So let me just explain. In the banking world, in banking companies, it's a little bit more complicated than just, say, an SME, where you may have some bank borrowings and some share capital. In the banking world, you've got quite a few tiers. So start off with bank deposits. So you and I put money into a bank. That ends up as a liability on the bank's balance sheet. They owe us money, but we're first in the pecking order. Should things go south with the bank, that we're going to get our money. Next, unsecured creditors. So trade creditors. Who do they owe money to? And then you've got senior bonds. So this is a type of debt instrument. So senior bonds. Then you've got a thing called tier 2 bonds. And then you've got these AT1 bonds. And this is where all the hoo-ha was about. And then you've got the shareholders at the bottom. So in a typical bank, and indeed this is what it was at Credit Suisse, you've got this. So this was the pecking order. So none of the depositors lost anything, because part of the deal with the merger with UBS and the Swiss government got involved. People who had money in the bank didn't lose anything. Great. Neither did any of these guys. However, these guys, the AT1 bondholders, were completely wiped out to the tune of about, I think it was something like $17 billion worth that AT1 bondholders had, this type of debt. They were all wiped out. But what's unusual, I mean, these are riskier because, look, they're closer to the riskiest category of equity, shareholders, than up here, the bank deposits. But nonetheless, bonds, you'd expect to get paid out, bondholders, before equity. But what happened here is, in Credit Suisse case, that actually the shareholders of the bank, Credit Suisse, did end up with something, whereas the AT1 bondholders ended up with nothing. And that is very unusual, because the regulators decided to upend the usual pecking order, as it were, and these guys were wiped out, but these guys below them in the established pecking order were not wiped out. This is very unusual. So what are these AT1 bonds? Well, it's a relatively newish type of debt category brought in after the financial crisis in 2008 to basically ensure that banks' buffers are increased, and a particular type of AT1 known as a COCO, which is a contingent convertible bond. In other words, these bonds turn into equity in the event that the lender is in trouble. So when you invest in one of these things, it is riskier than regular bonds, but the risk reward is that there is a higher return. There's a higher yield on these bonds. But no one expected that these guys would be completely wiped out at the expense, say, of some of the shareholders who weren't completely wiped out. So, in effect, the way that the AT1 type of debt was introduced after the financial crisis was just another way to increase the buffers of banks in the event that things go wrong. Basically, what they try to do in simplistic terms is say, look, these AT1 bonds, if things don't work out, it will be akin to what more of a bail-in rather than a taxpayer-funded bailout. That's the whole point of these. So if you're the investor, yes, you're going to lose your money if things go south, but rather that's you, Mr. Investor, than the general public and the taxpayer, and the government has to bail this business out to the tune of many, many billions. That's the theory. So they are a risky thing anyway, the AT1, but the issue here was that the pecking order was upended, and yes, the AT1 guys were wiped out, but the shareholders weren't. The shareholders did get so many pence in the pound, or whatever it is in the Swiss francs. They got something. They weren't wiped out like the guys above them were. Now, this has, like I said, it's created quite a furor in the banking market, and indeed, other institutions around the world in the last few weeks have gone on record to say, look, anything happens to us, we ain't doing this. We ain't doing what Credit Suisse did, because that is not how you go about things. So to calm the markets, regulators across the world and banks have said, look, if it was us, we wouldn't have done what the Swiss regulators did. We would not have wiped these guys out at the expense of these guys. So the normal pecking order would be resumed in the event of something going wrong with one of our banks, or whichever banks were coming out with this rhetoric. So it's very interesting. And also, following on from what happened only a couple of weeks ago, in the last few days, there's been a class action lawsuit brought by these AT1 bondholders against, I think it's against the Swiss authorities actually, to say, come on, this is not how it should be. Yes, we hold riskier assets below all this, but above these guys. But these guys did not end up with nothing like we did. How can that be fair? That's not, as I've just said. So let's see what happens in the courts. But just an overview there on trying to explain the particular asset holders within Credit Suisse who felt much aggrieved by what happened on that collapse, which was then try to stave it off by merging with UBS. So if you like this video, please do subscribe, and as always, I'll see you soon.